All right, welcome to Accounting 470, Governmental and Nonprofit. Now we're going to go ahead and get started with Chapter 14. Now I've done these out of order because, every textbook has its focus. When we did Principles 1 and 2, you may have noticed that we started off with the base case of a sole proprietorship, and then later on we introduced the accounting rules for a corporation. And same with this textbook. They take the base case as governmental and then explain nonprofit later on. Now, I know many of you are taking nonprofit. Some of you, I guess I should say, some of you are taking this class because you're trying to complete your professional accountancy degree, but some people are taking it that have not had intermediate or advanced accounting, are taking this as part of a certificate option. So I'm going to try and keep the information relatively straightforward without delving too much into advanced accounting. But because this textbook takes a governmental focus first and sort of nonprofit secondary, I wanted to, because many of you are taking, those of you who are taking it for the certificate, are doing it specifically because you want to learn more about nonprofits. So moving the nonprofit part of the textbook up a little bit is sort of to give you a chance to understand the nonprofit part, and then as we go through and do more chapters on the governmental side of things, you have at least a basis for comparing and contrasting. Additionally, I find that the nonprofit part of it is a little bit, I guess, more straightforward because a lot of the nonprofit rules are FASB based, meaning they're more for-profit GAAP based, with obviously a good number of things that are different. So sort of starting off with non-governmental, nonprofit, then moving into governmental is a little bit easier in my opinion. Okay, well, let's take a look at what we've got on the agenda. Obviously, it's a definition of what is a not-for-profit. That's what NFP stands for. But there are governmental and non-governmental not-for-profits. So we're specifically looking at the non-governmental. Then what is NFP financial reporting? In other words, let's look at those financial statements. Then look at the accounting. Basically, we're going to look at some large accounts like general accounts such as what are assets, what are expenses, what is a revenue, what is a gain, and we're going to add one, what is support, because that is another type of account in not-for-profit accounting. We'll just have a brief sort of commentary on consolidations. This is more of sort of advanced accounting. And then as far as learning objective 5, there's actually a very good set of journal entries with descriptions in the last part of this chapter. I won't be going through them one by one. I'll just point you to the fact that if you want to sort of get a good example of all the different types of entries that are shown in a journalized format, the last section is a very good section. Okay, well, let's start off with our definition for non-governmental NFP. So there are not-for-profits that are government-based or government-sponsored, and then there are ones that are more, for lack of a better term, and in fact the AICPA more focuses on what's the definition of a governmental not-for-profit, and then says if you don't meet that definition, then sort of you are a non-governmental NFP. So FASB is the organization that sets the rules for non-governmental not-for-profit, and GASB, the governmental standards, are for governmental NFP. And we will get to governmental NFP when we talk about the governmental agency. So between them, the AICPA, FASB, and the Office of Management and Budget, they try and standardize the reporting for these two different ones to make them at least useful. But there is kind of one little caveat. If you are a non-governmental not-for-profit and you are receiving and spending more than $750,000 of federally granted funds, then you are, no matter if you classify as non-governmental and use FASB rules, you will have to go through a governmental audit, a governmental sponsored audit, because you are spending so many federal dollars. So what is the AICPA definition of a governmental not-for-profit? If your people in charge of your NFP are by appointment, In other words, appointed by elected officials, or they're actually elected officials elected by popular election. If the government can dissolve this not-for-profit, and then whatever assets the not-for-profit has gets returned to the government, that would be considered a governmental not-for-profit. Does this not-for-profit have the power to enact and enforce a tax levy? Meaning, is it like an independent school district, or is it sort of a water district, or something else where it's been granted by government the ability to charge a tax and you cannot not pay it, and therefore it raises its funds through taxation? So that would be a definition of a governmental not-for-profit. Some of these not-for-profits can issue debt, and where the debt is federally tax exempt. That is sort of a definition of a governmental not-for-profit. If you don't meet these, then you are sort of, by exclusion of these, you are a non-governmental not-for-profit. And that's the majority of them, actually. I mean, there's few that actually meet these definitions and are considered a part of the, as considered a governmental not-for-profit. Let's talk about what are the objectives of financial reporting for a not-for-profit. Obviously, we've been spending a lot of time with over your interest in accounting. You've been looking at a lot of for-profit businesses, and the reporting there are, you could say, the income statement is basically showing operations and dealings with customers. The statement of retained earnings shows how much shareholders and dividends are declared. And the balance sheet is sort of a statement of financial position. You could also say the balance sheet is somewhat of a statement of the company's dealings with its business partners, loans and bonds and accounts payable and wage payable. Those are all the business partners. And of course, the cash flow statement have to understand your cash position, because profit, net income, is not cash. Therefore, you want to know cash. So what do we have as far as objectives for financial reporting for a not-for-profit? Well, we've got a number of different things here. We've got resource allocations, how to make decisions with the sort of assets that a not-for-profit has. What are the services they are providing, and what is the ability to provide them in the future? Again, we are pointing out this word that you don't see that often with for-profit, the idea of stewardship. In other words, you've been granted or donated funds or assets as a not-for-profit. What are you doing with them? Are you using them correctly or for the proper purpose? And are you doing it efficiently and effectively? Here we have assess economic resources, obligation, net resource. Okay, so that last one is actually kind of normally what we would consider for-profit. What are our obligations? Those are our liabilities, net resources, net changes. Who are the stakeholders for these reports? Donors, people who grant, members, lenders, other resource providers for the not-for-profit. Now, the NFP will use accrual basis to report. Now, take a look at these names. Statement of financial position. What do you think that is? That is something akin to a balance sheet. Statement of activities. What does that sound like? It's similar to an income statement. And then statement of cash flows. You notice we're missing one. We do not have the statement of retained earnings or statement of owner's equity, because we do not have that category of accounts with not-for-profit. There is no owners. There is no shareholders. We're not issuing stock. This is not a public corporation. So we do not have a statement that looks at that. Other reporting requirements, and we'll actually see this a number of different times. The reporting requirements is we have to report by function, which means as we are receiving donations and funds, and as we're spending them on things, we're going to divide them up into two basic categories. We're going to look at the same information sort of twice. We're going to look at that information, both revenue and expenses, as whether they are being used for the program. And when we say program, we mean what is the mission? What is the purpose of the not-for-profit? Is it a children's hospital or whatever it is? The certain amount of the donation is spent directly on providing the services that you have stated for your mission or as the purpose of your not-for-profits. Part of the funds that you receive and that you spend are in support of the actual organization. So you have to have employees, you have to have a certain amount of expenses running the program in order to, independent of, providing the actual services, it's actually supporting the organization. And though one of the big categories in support is fundraising, right? The ability to raise the funds so that you can actually apply them to program is part of support of the organization. Secondly, we would look at the expenses by classification, just our normal sort of expenses that we would look at from a for-profit point of view. They'd be salaries, rent, depreciation, all those sort of things. Sometimes there are comparative financial statements. They're encouraged but not required. And therefore, I don't think in the examples that we have, I have a comparative set of comparative set of statements, although you can find them. So here are the statements that we're going to go through, and I'm going to sort of flip back and forth from this screen, but we've got the statement of financial position, and I want to point out, I guess here are some of the important things I want to point out. We're going to look at the statement of financial position, and we're going to notice one of the big differences is we have categories of with donor restrictions and without donor restrictions. Statement activities, we have something called a reclassification. Statement of cash flows, there are some important differences about financing and investing, specifically with plant, property, and equipment. And then we have an additional, it's not a required statement, but it's required to be, this information is required to be published somewhere, is reporting of expenses by nature and function, just what we were talking about, whether it's program of support or whether it's by a certain category. And then here are some notes. Let's first start off with the statement of financial position. So one of the things we want to pay attention to is how it divides things up between with donor restrictions and without donor restrictions. So here is a balance sheet, a statement of financial position. Funny enough, they listed it as a balance sheet because remember, many times the non-governmental, not-for-profit use FASB. So here it's listed as a balance sheet, but you can see it's not like a balance sheet you've seen before. I'm going to scroll up here just a little bit so we get the entire amount. So on your normal balance sheet, you have assets equals liabilities plus equity. On a not-for-profit, remember, we don't have the equity section. So what do we have? We have assets, we have liabilities, and then we have net assets. So our new equation is assets minus liabilities equal net assets. So you can see here, total assets was 159, total liabilities was 51, and so total net assets was 107. Well, so there was a little bit of overlap. Now, also here, when we list, they don't do it all the way through, but at the bottom, they keep track of, and this is important, so within the net assets, remember, are total assets minus total liabilities. Within the net assets, we actually break it out into without donor restrictions and with donor restrictions. And you can see here's the total liability to net assets, which is the total assets. So what is a donor restriction? When someone gives something to a not-for-profit, they can just give it voluntary and unconditionally, and therefore there are no restrictions, or there can be some sort of restriction. Sometimes assets are given, I'm saying assets in general, it could be clothing, it could be equipment, it could be cash. So think of it how you'd like, but any type of asset given, it could be said this is used only for this coming fiscal year, or it's only used for a certain purpose. And those are the typically the two main restrictions, that there is some sort of purpose or some sort of timing restriction. Now, these restrictions can be temporary, meaning once the restriction sort of, for example, if you said it can, we want it to be used first for next fiscal year, and once that restriction is over and there's still donations left, then it becomes unrestricted. In other words, a donor without donor restrictions. So there are temporary restrictions, and then there are permanent restrictions. And permanent restrictions are typically called endowments. And these can be things like held in perpetuity, artwork or land or other thing like that. So the donor can, when donating something, can either put a restriction on it or not. And we are required to keep track of all of our assets and liabilities through whether or not there is a donor restriction or not. Now, not only can the donor restrict things, but there is the situation where the board members of the not-for-profit can, independent of the donor, designate things as being restricted. And this is sort of different from for-profit. I have said before, or you perhaps may have had a class from me where I've said one of the actual, inability of GAAP financial accounting, the normal financial statements, is there's no way to earmark things for future use. There is no T account. There is no account that says this is money being set aside for capital expenditure, right? It's just money, and you may have a desire to spend it on that, but there's no way to formally set something aside. Well, that's a little different, and I think it's actually a good thing for not-for-profit accounting, is that you can actually designate stuff as having a future purpose. And so in addition to donors restricting things, the board of directors of a not-for-profit can actually restrict certain items too, to say we are withholding this to add it to the endowment, or we're restricting this sort of amount of money for capital expenditure in the future. So there are donor restrictions which we're required to report, and there are sometimes board designated restrictions which may or may not be captured by the financial statements. So if we go back and take a look at, and also I would say, if we looked at the assets and liabilities, these are typically done according to what we would consider GAAP. In other words, they're done according to liquidity, cash, investments, AR, inventory, and working our way down to fixed assets. And same with the liabilities, they're kind of done according to liquidity, or at least done in sort of a current and non-current fashion, even though we don't have categories of current and non-current. So that was the statement of financial position, where I wanted to focus on the donor restrictions. I guess I should have also said let's focus on the assets minus liabilities equals net assets. That's also sort of a new thing. Let's look at the statement of activities and remind ourselves to look at the classifications. Now here is a statement of activities. Now again, you notice that it is divided between donor restrictions over here and without donor restrictions. And so we have revenue, and on this next page, we're going to have expenses. So let's come back to that. Let's look at the revenues first. So contribution and grants and fees from exchange transactions. Okay, so we're going to get a little bit more into what is an exchange transaction and the different categories. But these are things that are where you can look at some of the definitions here: subscriptions, sales of materials. In other words, when we say it's an exchange transaction, it's sort of like a for-profit exchange, meaning someone gives us money and we give them something of benefit. And so that would be a subscription, a program service fee, something like that. Now, a non-exchange transaction would be just like a donation or a grant. So these contribution and grants, they don't say it that way, but these are considered non-exchange transactions. So without donor restrictions, you can see all of these. And you notice that a lot of these are some of these things are done as net, And then some of these are done, for example, special events, less cost of direct benefits to donors, just like we would do total assets less accumulated depreciation. There are some times where we want to have the breakout. And here we'll come back to special events, but I'll just show special events. This may be the amount that was taken in from the donations for the special event. Say it was a charity event like a concert or an auction or a dinner to where, it's like $200 a plate or something like that, a speech. Well, that's the amount of money that came with the donations. But in order to put on that event, you had to, hire a speaker, or you had to hire bands, or you had to pay for the catering or whatever it was. And so what we've kind of shown here is the total amount of donations brought in by the event minus what it costs to basically put on the event. Bequests, federated and non-federated organizations, donations. So you can see these are things, the contribution and grants is an area where people who gave the money don't expect anything in return, essentially. And then fee from exchange transactions, that is some sort of kind of normal business type activity where you're doing something and someone's paying for a service or something like that. Now, the donor restrictions, the one I wanted to show you is, remember, donor restrictions can be temporary, meaning they could have a temporary purpose or temporary timing. And so even though they were originally recorded as with donor restrictions, at the end of the year, because this is December 31st, and for the year ended December 31st, you notice out of these total 53,000 here and 1,000 here, 43,000 was reclassified. In other words, that means that amount were, even though they were donor restriction, they were temporary donor restrictions. And so they, at the end of the year, they went from being with donor restrictions, and you can see here's the number where it's been added to without donor restrictions. And so that is what we call a reclassification, or sometimes we say a release, net assets released from restrictions. And that's different. That's different from what, a normal income statement. We don't see those sort of things. How about for expenses? Remember, again, we said very clearly that expenses need to be divided between the amounts of money or amounts of funds that we spend on the program. Remember, the program is our mission, is our purpose. So the purpose of this particular organization, they have three purposes: research, providing information, and then advocacy and public awareness. And so this is the expenses that they spend on that, 162. Supporting services, management in general, that's basically the odds and ends, such as bookkeeping, running the offices, any legal work you had to have done, et cetera, et cetera. And then, of course, the major supporting service is fundraising. It's all the money that you spent towards actually organizing to make, like public relations and that sort of thing to raise funds. And there you have the previous is total revenues down here. And then you'll have total expenses. And we don't say net income because we don't have net income. We have total revenue, total expenses, and this should be change in net assets. Change in net assets. So net assets at the beginning of the year, net assets at the end of the year. So we ended up spending more than we brought in total donations, and so therefore our net assets declined by 10,000, even though the donor with restrictions went up by 10,000. So that's hard to say for every not-for-profit. The idea, you kind of look at these two numbers here. One category went up by 10,000 and a little bit, one went down 10,000 a little bit. Typically, I would say not-for-profits, depending upon what type of area they are, they would probably want this to be, yes, close to zero, or, some number that's not too, they don't want to be making a lot of money because they want to be spending that money on their program activities. But they do want their sort of endowment, the donations with restrictions to be going up. And you can see that's sort of the case here. Even though they're sort of current funds used for running things has been kind of just kept to a minimum, their donations with restrictions has gone up by 10,000. So let's take a look at the statement of cash flows. And the one thing that I kind of want to point out here is we're going to talk a little bit about plant, property, and equipment or long-term assets. And there is a little bit of difference between how we classify them in financing versus investing. So let's go ahead and take a look at that. Now, here, statement of cash flows. And let's see, I think I have it on 2 pages. Here's the cash flow, investing, and financing. So let's go back to the cash flow from operating activities. So this is prepared pretty much like the cash flow statement for-profits is done, except you can see what is our beginning amount. It is the change in net assets, right? Now, if we were to go back here and look at the difference between net assets for, let's see, 2023 and 2022, you would see that that is 598. And when I went to go through and check something like the increase or decrease in accounts receivable, 2118, well, I wasn't able to do that because when we look at the balance sheet, the accounts receivable is net. So I would have to have the gross amounts to be able to double check it. But it's in the ballpark, so it looks correct. I wasn't able to confirm all the numbers though. So when we look here, we start off just like we would start off with net income on the regular cash flow statement. Here we start off in the change in net assets. And I have to just point out that obviously this particular cash flow statement looks like the normal cash flow statement. But remember, even for-profits, you have the option of doing it in the direct or indirect manner. So this is obviously the indirect manner, the one that we study the most in for-profit accounting. But there are some organizations that could do it as a direct method. Just if you do the direct method, you need to reconcile it to the statement of activities, basically the income statement, and make sure it matches the change in total net assets. When you use the indirect method, well, it does reconcile because you start off with the change in net assets. You're actually using the statement of activities number. So just FYI, we're looking at an indirect version, but not-for-profits can also use the direct method. So another thing to kind of point out, whereas on the other financial statements, we did look at donations or donor with donor restrictions and without donor restrictions, we don't actually break that out here in the statement of cash flows. That's not broken out. Normally, gift with restrictions are going to be in the cash flow from operating activities. And when we get to the financing and investing, we will look at those gifts or those donations that have some restrictions as far as long-term purposes. So just like we add back in depreciation, amortization. Here's gains and losses, obsolescence, the other things we normally deal with investments, and then the adjustments for changes in operating assets and liabilities. And if you remember, if an accounts receivable went up, well, then we assume that the cash position went down. So for assets go up, cash goes down, and vice versa. If assets go down, cash goes up. In other words, for assets, the cash goes in the opposite direction. So whether it's up or down. And liabilities and equity, just to remind you, whichever direction the liability or equity goes, cash goes in the same direction. In other words, if your note payable went up, well, then your cash went up. If your note payable went down, well, you had to pay it off with cash. If stock went up, you received cash. So that's the sort of rule of thumb. And so decrease, increase here, you can just see that this is the normal sort of things we do. We run through all the current assets and the current liabilities and come up with a net cash provided by or used if it's negative in operating activities. So this is relatively straightforward and it follows the same sort of format that a for-profit cash flow statement, just with the difference of we don't start with net income, we start with net assets. On the cash flows from investing activities, Now, just to remind you, and for those of you who are taking certificate, is it maybe a good reminder, the the previous page, operating activities are basically all the sort of day-to-day running of the business. And typically we take this information from the income statement, and for the for-profit, we take the information from the income statement, and then we look at adjustments for current assets and current liabilities. The long-term assets typically are investing, and the long-term liabilities plus equity are in financing. And even though the word investing and financing is similar, you have to remember that they have sort of specific meanings with the cash flow statement. I almost want to say investing is probably better termed reinvestment. When we talk about investing activities, we're not talking about investing in debt or equity securities or anything like that. We're talking about what is the profile of our long-term assets. Remember, a company owns assets to be able to generate revenue. It doesn't own assets just for the sole purpose of owning assets. So if a company buys a piece of equipment, that equipment is depreciated, but it bought the piece of equipment so as to generate revenue over a long period of time. Well, a company just doesn't want to let the equipment fully depreciate and turn into dust. What it does is it sort of has a capital expenditure policy where it wants to reinvest, wants to take funds and buy new equipment, or, refurbish the factory. But when we talk about investing activities, it's typically saying we are trying to maintain the efficiency and effectiveness of our long-term assets. And so you can see from a not-for-profit point of view, what are their long-term assets? Well, a lot of times is they take donations and put them into investments. And so you can see not only is there purchase of fixed assets, but there are investments here. So investing activities are, basically maintaining your ability to continue to produce, well, for a for-profit is to produce revenue, but for a not-for-profit is to continue to be able to reinvest in your organization so that you can continue to provide program services, right? Whatever your mission is, that you can continue to do your mission to be able to enable that. Cash flows from financing activities. This is where do you get capital? Well, capital from a for-profit point of view is, you have to think about capital as being from two areas, right? There's internally generated capital, which is retained earnings, and then there's externally generated capital, which is stock. But we don't have those. So a financing activity is basically, you can see here, it is contributions restricted, sort of have a permanent restriction to be an endowment, right? So it's not that it's not the same as someone who invests in a company because they get shareholder rights. Someone who donates to a not-for-profit and then creates a restriction, a permanent restriction that it's used for endowment, they don't get anything in return, unlike a shareholder in a for-profit. But some of the activity is the same, is that they're trying to get access to capital. So keeping the endowment going so that you have interest investment income off of that is a financing activity. And you can see some of these others, access to capital. Now, one thing I want to say about plant, property, and equipment as far as this is that they have, and you can read some of the rules in the textbook, assets used for acquisition of building and equipment is a normal investing activity, purchase of fixed assets. But if there are some assets, whether they're cash assets or something like that, whose long-term purpose under their restriction is for acquisition or building or equipment, that would be included in financing. You have to think about, now, if someone gives an asset and says, go ahead and buy a fixed asset such as a building or a piece of equipment, that is investing. But if someone donates something and says, there's no specific direction on how to use it, it is just to be used to, improve the buildings or to buy equipment as necessary as time goes on. In other words, it has a restriction and it's sort of a long-term piece of capital to where the restriction is that this is used for future improvements of plant, property, and equipment. Well, that is sort of a source of capital for the future, and therefore, and it's sort of a fine line. And like I say, by all means, read the textbook to see if that's of something of interest to you. But those sort of assets who are restricted to future investment in capital expenditure, that is a financing activity. When we look back here on statement of cash flows, I will just say this next one, we do actually have a financial statement, but it is not a required financial statement. But the information is required to be reported. It's the reporting of expenses by nature and function. And we'll take a look at that here in a second. So it can be a separate statement, and in our case it is, or it can be explained in the notes. Perhaps it is you have a smaller not-for-profit that doesn't need a full statement, or it can be reported actually in the statement of activities. So it can be sort of a subcategory there if that fits the bill. So let's take a look at what we've got here. Here is our reporting of expenses by nature and function. So nature, they use a couple of different words. This can be the category. This can be the classification. Sometimes they call it classification. Function is typically, that's the word they use. And there's two functions. And you can see the two functions here are program activities and supporting services. We've already talked a little bit about it, about these expenses. Program expenses are ones that support, I don't want to use the word support, that are directly used for the mission or whatever our purpose is. And you can see that there are three branches of the program mission: research, information, and advocacy, right? And then there's supporting services. We get the management in general and then the fundraising. So across the top, we are breaking it out by function. Down the left side, we are breaking it out by nature or classification. And you can recognize a lot of these as our normal categories that we would think about expenses. There are supplies, fees, telecommunications, equipment rental, all these sort of things are what we would consider. And this is what they mean by nature. The ones on the left are the nature. We can also call those categories or classifications. But the function, there's a program function and a support function. And as you can imagine, this is one of the key sets of data that people who want to figure out whether or not a not-for-profit is doing a good job is to look at this. They will look at the difference between the total amount of money spent on program activities versus the total amount of money spent on support services. And that could be a ratio. It could just be a total dollar amount. And, if it's the ratio, they're basically going to say, here we've got 162 versus 58. So together, 221. It's not quite a 1-to-3, but it's around there, right? It's about, there's somewhere in the nature of 20%, 25% is being spent of all the donations. 25% is being spent on support services, and 75% is being spent on program activities. And so when you look up not-for-profits, they will typically state in their literature, out of every dollar, 75 cents goes towards, towards our mission. And that may be one of those things that they try and improve over time, or they may be saying within our category, we're the highest, we've got the highest ratio of program funding versus support activities. Let's see. The ratio is a natural measurement of efficiency. And you can see it's all broken out here. And you can see within which each category, how they're spending it. And so it's actually a very informative document when they actually break it out as its own financial statement. Next, we have just some of the notes to the financial statements, and these will be similar to what you would see in a for-profit. There's always a lot of information that you have to generate for any financial instruments, whether they're debt or equity securities, contingencies, contingent liabilities, prior period adjustments, changes in accounting, principles, employee benefits, credit risk. One thing that is required is, and again, this is unlike for-profit. Remember I said there's very little in for-profit accounting to talk about look ahead or earmarking dollars for a particular project. Here they say 1 year liquidity for general expenditures. In other words, they want to show, there is a note to show whether or not they have enough liquidity to continue on their normal expenditure rate. And I guess the closest thing that we would have to that in for-profit accounting, we actually talked a little bit about it in audit today, and that's the test of a company as a going concern. And while a going concern is a little vaguer, it's not as specific as 1 year liquidity for general expenditure. It does have sort of the same connotation. Will the company be around in a year's time? Okay, let's talk a little bit about not-for-profit accounting. Let's look at some of the broad accounts and how they're similar and different to for-profit accounting. So already we know that revenues are increase in net assets, and this is different from for-profit accounting. I guess you could say for-profit is an increase in assets, but we think of it more as an offset versus income, right? So there is no net income in not-for-profit accounting. It's an increase in net assets. And revenues specifically, if we got specific, we typically talk about revenues in regards to exchange transactions. And remember, we said those are the things that are sort of business-like activities where you're selling a service, you're selling a product, you're providing membership, you're doing something along those lines. And so we would consider those revenues because they're very business-like or for-profit type activities. What is a gain? Well, just like what we've always said, a gain is there are incidental increases in net assets, sort of like from a disposal of an asset and you got more than the book value. Well, that's a gain. The new thing that we need to look at is a category called support. Now, we didn't see that on the statement of financial activities. We just saw contributions and donations or contributions and grants. But as a general category, it is a non-exchange transaction. So it's different from a revenue and different from a gain. So support is an increase from non-exchange transaction. Now, we did talk about the idea of restricted or unrestricted. And you can see here where I've said restricted or unrestricted typically is for purposes or for time. There is actually one additional thing that we need to consider before the restricted, unrestricted nature of a donation are there conditions? And these are sometimes a little bit, it seems like we're using the same word. Is it conditional or is it restricted? Conditional, when we talk about the terms in accounting for this or not-for-profit accounting, is we talk about barriers. So someone may be, if someone says, I restrict this donation to be used for a certain purpose or for a certain time, that is considered restriction. And those are the two primary categories of restriction. A condition might be, and as we say, we use the word barrier. A condition might be, I will give you this donation granted that it be used to hire a certain person, or be used for with a certain trying to give a good example. They specifically say you have to hire this particular person or you have to do something else. In other words, there is a condition that needs to be fulfilled before the support will be considered as viable. And then beyond that, there may be restrictions as far as purpose or time. So it's more of a very specific type of condition as opposed to a general purpose or time restriction. And it could be that, they want to say you can only use this once you have reached a certain level of profitability or something else. So when we say barrier, there is some condition that needs to be fulfilled. And so it's more specific rather than a general type of restriction, which is purpose or time. A restriction would be to be used within this fiscal year or something like that. So conditions have barriers attached that need to be, the condition needs to be fulfilled. And so you can have a conditional or unconditional donation. And then once the condition has been fulfilled or there's no condition at all, they can further be restricted or unrestricted. So what type of support types are there? In other words, what type of donations? A promise to give, and that's a pledge. So a promise to give is where they, think about telethons, where people call up and they say, I promise to give this much. How much can I put you down for? And that is a promise to give. It's sort of a pledge. And sometimes they come with a condition, typically not. Typically they're not restricted, they're unrestricted. And there are situations where you can have unconditional promises that are supported, but as you can imagine, you haven't actually collected a pledge. So from a telephone, you record, all of these pledges. There's likely to be a certain amount of those pledges that actually don't come through. And what I'm working up to is a very interesting and unique situation is that sort of like accounts receivable, a promise to pledge is, someone promises to give you money, just like accounts receivable says, we promise to pay for the goods or services, but they don't always come through. And so in not-for-profit accounting, for promises to give, for pledges, you have to determine a net realizable value if the pledges are less than a year. If the pledges are less than a year, and in order to determine a net realizable value, just the same as accounts receivable, you need to create an allowance. And what do you think the allowance is called? It is called the allowance for uncollectible pledges. Now, if the pledges are go out into the future, let's say someone says, I plan to give X amount every year for the next 5 years. Well, the ones greater than a year are going to be considered net assets with a donor restriction, right? So in other words, if it pushes out past a year, then you're talking about a time restriction, right? But pledges within the year, you have to basically say we assume a certain amount of them aren't going to come through. Therefore, we have to have a net pledge. The net pledge, just like a net AR, is that the realizable value will become from total pledges minus the allowance for uncollectible pledges. The next category, donated materials and services, non-cash contribution or gifts in kind. It can be, donations of clothing and furniture to thrift shops. Sometimes radio stations give out free advertising for good causes. On TV, you see public service announcement type commercials. Sometimes companies that have excess office space might, rent out office space to not-for-profits or charities at a reduced rate or a free rate. So they're not giving cash, they're giving some of what they have, goods or services, and that's why we call it gifts in kind. And so these are reported at fair value. I'm sure most of you have gone to Goodwill. And Goodwill, once you donate some items, ask if you want a receipt. And at that time, they typically ask you, what do you think it's worth? They don't really appraise it. But in a lot of situations, there is a certain amount of appraisal going on with you're saying, well, how much, I'm donating this office space. How much, what's the appraisal of that? And there are situations where, let's say you have a long-term charity that's going to be, professional charity that's going to be taking office space, and you don't just give them the office space. You might give them a less than market rate on their office space. And so whatever the difference between the two, between the market rate and what they're paying, that would be considered the donation. It is a little tricky to quantify, and we're going to look at the statement here in a second. There's a couple of rules about it, and it says the rules are if you create or enhance non-financial assets. So for example, if someone is a carpenter and they help build out your store or something like that, well, you don't consider that as a gift of a service. They're actually improving an asset. Now, if you're talking about a service, for example, someone requires specialized skills that would need to be purchased if they weren't provided. In other words, your mission requires a certain skill that if it wasn't provided free of charge, if it wasn't donated, if it wasn't a volunteer, then you would need to go out and to pay for it. And so we've got an example of that here on the on this next thing. That is, this is taken from the textbook again, but the American Diabetes Association. And it says here, we recognize contribution revenue as professional fees, fair value of services donated by volunteers. So just what we're saying, fair value services donated by volunteers with a peer review process. Okay. So here we're talking about medical services. So part of the program or the mission provided by American Diabetes requires a certain level of medical expertise, right? So here they're talking about some program activities, camps held for children with diabetes. Well, you need some medical professionals, perhaps nurses or other things like that. So contributed services for occupancy and recorded in occupancy. The association recognized, $3 million and $2 million in donated services provided in conjunction with this association's activities. In other words, those services to where if they didn't have volunteers do it, they'd have to go out and pay for it to be able to provide their programs or to do their mission. That would be considered that they could list as a donation. But you notice this next paragraph here. Many other volunteers made significant contributions of time, but the value of those contributed services do not meet the criteria for recognition and are accordingly not recognized as revenue and expenses in the consolidated. So there's a very thin line, and you can notice where volunteers can be considered donations. And here, they say they go through a peer review process to make sure that they're classifying correctly those skills that are necessary to run their program that are donated versus general volunteer work. So just be aware that is a kind of it's not as a cut and dried as you might think. Volunteer, okay, we can count that as labor, and that's not the case. When we go back here to looking at here, so that's donated materials and services non-cash. So it's recorded at fair value, but it's tricky to quantify. Donated land and equipment, again, recorded at fair value. That's the FV. With or without restrictions as necessary. And as I mentioned, if you provided a building for use at a reduced rate rather than free, it's the difference between the rent and the market rate that is the contribution. And typically it's a contribution without restrictions. Special events, we kind of pointed that out on the statement of activities, where you had a special event, you record the gross amount of the donations less the amount of expenses necessary to actually put on the event, to hire the people for the concert or to cater the dinner, or if it was a speech or something like that. So that's reported gross less benefit of the expense. When we're talking about expenses, again, they're on accrual basis. They are decreases in net assets. We record them two ways. We record them as functional expenses, and we saw that in that report on expenses. So it's the program activities versus support activities, and we look at the categories and classifications. I'll just point out here, the textbook actually had an important thing, or sort of an interesting point. There are some not-for-profits whose purpose is primarily fundraising, like the United Way. In other words, they don't provide services and programs directly, they help other not-for-profits raise money. So they have people, they're sort of an umbrella organization, or maybe better is a feeder organization, where they spend most of their program is to raise funds for other not-for-profits. And so their functional expenses, program support might look a little different. So they may have more campaign and public relations or investor relations as their program services, because they're basically saying, we specialize in the not-for-profit area as networking, right? We're out there, we've got better networking than most not-for-profits, and therefore we're better at fundraising, and we're passing that fundraising off to the other not-for-profits. There are accounting rules for joint activities. If you're doing program work, in other words, you're doing your mission, but you're also doing fundraising, well, you can see that's one of each. That's something that's doing programming and support. They gave an example of, let's say you had a door-to-door campaign where you're helping people, you're trying to talk to people about neighborhood safety or something like that. Maybe that is your primary purpose, but you're also soliciting donations. And that made remember when I was in the Boy Scouts, we would go around, and some Saturdays we would sell donuts. We'd do door-to-door selling Krispy Kreme donuts. And I don't know if that would fall under that activity, because I don't think we directly solicited donations. We were selling the donuts. Although, maybe if someone wanted to give us extra above and beyond the amount of the donuts, we would take it. I remember we would take it. In other words, I guess we said that the donuts are X amount per box, and we accept any other, I guess we did say that, any other donations above and beyond. So that would be something like a program and support activity. And just realize I'm not going to go into all the rules. There's a lot of detailed rules, because we're mixing two different things: program activities and support activities. And if you're interested in it, there's a little bit more detail in the book. What are management and general expenses? Well, we've kind of talked about it. It's all the other things outside of fundraising to keep the organization running. So there's legal, there's accounting, running the office, PR, publicity, that sort of thing. The assets are very similar to the for-profit. There's the exceptions, assets with donor restrictions related to long-term use. We pointed that out with the cash flow statement. We separate them from current assets. And remember, not only can there be donor restrictions, but sometimes there are board-designated restrictions as well. Investments in debt and equity securities. Well, debt and equity, that's just bonds and stocks. Their contributions are recorded at fair value at the time of contribution, and they're revalued at year end. Of course, that can give rise to unrealized gains or losses, and we report those in the current period in the statement of activities. There is no comprehensive income for not-for-profit. It just goes straight into the statement of activities, but it does require extensive disclosures. There is a set of assets that is very specific, and those are collections. And, these are things like museum collections. These are capitalized, and they're not depreciated due to, you notice they don't say indefinite life. This is, I'd forgotten about this, but there are very long useful life. And what they're talking about is that it has some importance to culture, and therefore it's probably going to be around for such a long time, or a long enough time that there's no reason to depreciate it, because hopefully it'll be preserved for a long time. Think about the Mona Lisa, right? It's been around for 500 years or 600 years. That is, it definitely has a finite life, but it is receiving the best care possible to extend it so it is not depreciated. So what is a collection? Well, it must meet 3 criteria. It's held for public exhibition or research or education, or all 3. It is protected, cared, and preserved. And it's not to say that you can't sell off items in your collection, but if you do sell off items in your collection, the proceeds must be used to acquire new items. And so sometimes there is turnover in collections, not to say that that can't happen, but if so, you have to maintain the collection, maybe not the absolute dollar amount, but there's the idea is that if you sell off something, that you're selling it off to build it to continue to build it, or at least maintain. Our last section here, and like I say, because we have different types of students, we got professional accounting students and we've got certificate students. I'm not going to get too much into consolidations and combinations because not all of the accounting students have had advanced accounting and so don't know about business combinations. So let's just talk about it in general. If a not-for-profit invests in a for-profit entity, there's going to be two situations. Either it has a controlling interest or not controlling interest. And if it has a controlling interest, it needs to consolidate the for-profit entities into their financial information. If it's a non-controlling entity, if it's a non-controlling interest, we would just use the equity method. And for those of you who've been through advanced accounting, you know what the equity method is. Sometimes a not-for-profit is a component of a government entity. In other words, it is created for the purpose of holding a resource for the direct benefit of the government entity. And the example that we have here is public universities, those are government entities, create not-for-profit entities specifically for maybe endowments. You've heard about, I'm sure there is a Black Hills State Foundation, right? In fact, I think Steve Meeker is in charge of the foundation. So that's probably a not-for-profit entity that reports and is basically controlled by the university. There could be alumni associations or something like that. So those are reported as part of that government entity rather than on their own. If they're there for the direct purpose and the direct benefit of the government entity, they're just reported as part of the government entity. As far as business combinations, a merger is two or more not-for-profits get together and they form a new not-for-profit afterwards. Well, they'll just combine their assets and combine their resources and report it afterwards. Report it as the new entity afterwards. If there's an acquisition, we'd go through normal business combination acquisition method. That's taking the fair value of the assets and liabilities, and we would figure out if there's a non-controlling interest part. We'd also calculate goodwill. That's the normal process. It is important to understand that it's not exactly the same. Sometimes goodwill would be considered an expense, and you may think well, if you've overpaid for an entity, that goodwill has to be an asset. Think of it along in this term. Remember, once you in a for-profit situation, once you have established goodwill, in other words, the amount that you overpaid, remember you have to test goodwill in future years. And if you find the goodwill has gone down, the value of the goodwill has gone down, what do? You have to impair goodwill. So it's almost as if they're saying in a not-for-profit situation that you would rather than go through the testing phase, you will just go ahead and impair that goodwill and charge it off as an expense. Like you skip straight to just determining that extra amount paid was an impairment. Okay, the last part is the journal entries, and I already mentioned at the beginning that I'm not going to go through all because it's an extensive list of journal entries. But if you're interested, and I think many of you will be, there's a lot of good journal entries in that learning objective section. And I think it begins on, I forget what page it is, 173, something like that. And give it a look if you're interested. And if you have questions about any of those journal entries, by all means, let me know. And I can help you work through them. Other than that, thank you. I apologize again for the problem with the recording equipment. I actually think I figured it out about 5 minutes after I signed off, which is kind of par for the program. But hopefully it'll be up and running for future weeks. We will still probably have a recorded version here or there, but I hope to be able to talk directly to you guys next week, which we will cover Chapter 2. Okay, thank you all, and have a good night, and talk soon.